I'm going to provide a little context for you. This is a map of the farm credit system. When I went into the farm credit system in 1980, there were actually 1,000 credit cooperatives like Ag Choice Farm Credit or like Farm Credit East, the organization I'm representing at the moment. And today there are about 78 organizations. And the biggest one in the country actually is right here. Comprises 4 states, and those states are Nebraska, where they raise a lot of corn, Iowa, where they raise a lot of corn, South Dakota, and Wyoming. We have a banker here from South Dakota. Where's Nathan? Nathan Franson is right over there. So Nathan represents the banking industry in the United States, and he's actually a representative of the American Bankers Association. The farm credit system is a highly regulated system. And a little bit like Miguel's organization, we cannot take deposits. By regulation, we cannot take deposits. And so the American Bankers Association and the Community Bankers Association, with whom we compete, make very sure that we don't do anything that we're not supposed to do. So we both have lobbying groups, and the lobbyists butt heads all of the time, so we let them butt heads. And in the meantime, Nathan and I might do deals. We'll work together very closely. So despite the fact that we have lobbyists that compete with each other, the bankers and the farm credit system in many ways work very closely with each other. Now, that largest association that I pointed out, actually there's an interesting story about that, and Ross and Hans won't remember this because you're too young, but I think it was in 2005 when you were showing us that map this morning. I think it was in 2005 that Rabobank tried to buy Farm Credit Services of America. I think that was about the time that that happened. And that was an interesting situation because up to that point the farm credit system associations could do nothing together. And all it took was an attempt by Rabobank to buy one of those associations, the biggest one in the country, and all of a sudden the farm credit system really coalesced. It came together, and it was able to stop the purchase by Rabobank. It could have been good for the farmers. There was a real interesting struggle, though, and it really did lead to a stronger farm credit system as an unintended consequence. So what you'll see is a mishmash of colors, and for historical reasons, there are a lot of mergers that took place, and there are some overlapping territories, so it gets a little bit confusing. And just to focus in a little bit on the associations where I came from, this is Farm Credit East. It includes the state of New Jersey, Connecticut, Rhode Island, Massachusetts, Southern New Hampshire, and New York State. Farm Credit East is now in the process of working on a merger with the state of Maine. Farm Credit East is about a $4.8 billion association. They have about 13,000 customers. So if you do the arithmetic, I think that puts the average loan size at over $300,000 per customer. Ag Choice Farm Credit, the one where I most recently came from, and I retired there in the end of last year, was about a $1.5 billion association with about 8,500 customers. So our average loan size was about half of what Farm Credit East's was. So there are big differences in the associations. And if you look at where we rank nationally, Farm Credit East is probably in the top 5 to 10 in terms of size in the farm credit system, and Ag Choice would be somewhere around 20 to 25th. And so the things that I'm going to share with you next really are pretty typical of what goes on in the farm credit system. I have to say that Farm Credit Services of America, the largest farm credit association, has a very sophisticated and robust portfolio management. That's not what I'm going to show you. I'm going to show you what is probably most typical for most of the farm credit associations in the country. And we have some issues because we've had the technology for a long time, and what that means is we've created databases, and we have silos in our databases, and for legacy reasons we've just not been able to get it all put together. So that's something that's an ongoing process of trying to coordinate all of the databases that we have. Farm Credit Services of America has solved that problem, It only took them $40 million in about 3 years to do it, but they've solved that problem. And I'll talk a little bit more about what some of the implications of that. This is the conclusion. So I'm going to give you my conclusion right up front. So, and I'll wrap up later and come back to it. But I want to do that because this is really what the kinds of things that I'm going to be talking about, and you'll see bits and pieces of this as I go through the presentation. It's not in your book, and I did a paper that more or less summarizes what's in the PowerPoint that I'll be going through, and I'm giving that to Dakota, and she's going to download it so it'll be available to you. And the other thing I'll mention is we did a webinar for the World Bank about a month ago. I forget when that was. It was about a month ago. And there were 3 segments to it. And if some of this, if you would like more information about how the Farm Credit System operates and how we're funded, I would encourage you to go to that webinar because I think that explains it. However, if you want to contact me directly, I'll give you my contact information at the end, and I'd be happy to follow up. So here's the conclusion. First of all, when you're doing loan portfolio management, I believe it's important to, first of all, do an enterprise risk management survey. Now, I'm not sure that enterprise risk management principles are global, but they're used widely in the United States. And all we're saying here is you need to have some principles on the major risks that you're likely to be facing. Make sure you've identified the major risks and that you've properly addressed each one. Once you've done that, you have to do strategic planning. We have a board of directors, and they do the strategic planning with management. Then goals and targets are set. You have to have a system for monitoring and reporting the results of your activities on an ongoing basis. And we use something that I think it was Bill Gates developed this. Bill Gates, Bill and Melinda Gates fame. It's SharePoint. Of course, it's a Microsoft product. And it's something that most of the associations use for a number of different reasons, but one of the important uses that we have for it is to create dashboards and give us timely ways of looking at the output of what our credit activities are doing. So we use SharePoint, and it gives us the transparency that we need at all levels of the organization. We want the board to be able to get a snapshot view of what's going on, be able to monitor important trends, and at the same time the staff and management need to know what's going on. And full transparency is really the underpinning to our philosophy. In addition, it's important to do stress testing. You need to create some scenarios where if certain bad things happen, that you've thought about what might happen and how you might respond to it or how you might prevent it, actually. And then you need to develop some contingency plans. So if those bad things happen, exactly what are you going to do? And finally, you need a robust internal audit and credit review process. And I jokingly tell the staff, I said, I don't care how much you fool the regulator, but we must never, ever fool ourselves. Now, of course, we have to be transparent with the regulator as well, so I'm only kidding when I say that, but the key point is never, ever fool ourselves in terms of what's going on in the organization. So let's dig into this a little bit. So let's say we've done our enterprise risk management assessment, and we understand what the major risks are. Then we have to go to the board of directors, and every Farm Credit Association. By the way, I need to back up on one point. In the United States, there is a lender of last resort, and that's the United States Department of Agriculture Farm Service Agency. So there is a lender of last resort. So we can get guarantees through them. We call them FSA, Farm Service Agency. They will guarantee loans, and they will also provide direct funding in certain circumstances to borrowers. So if someone doesn't qualify for financing from the Farm Credit System or from a commercial bank, they can go to the Farm Service Agency, and maybe they can get credit that way. But moving on here, the philosophy of the board is really key in getting things started. And the boards differ, marketplaces differ, and so the boards will differ. So from place to place, the boards will have different philosophies. And it's kind of interesting with the mergers that have happened over the years, how people have discovered, well, maybe the philosophies aren't so different, but the markets are definitely different. So the boards have to be cognizant of what's going on in their local marketplace. Then they set the goals, they set targets, and they set limits, and then we build policies and procedures around that and create an underwriting process to make sure that we are properly underwriting and managing the risk. Beyond that, we do the monitoring and the stress testing that I already referred to. We've got the audit and review process, and this all has to be integrated with financial and capital management. So what we talked about this morning and earlier today has to do primarily with the credit risk aspect of the whole business. But we need to take a broader look. We need to be sure that we're managing the whole portfolio and we're looking at the financial strength of the organization, making sure it's well capitalized. So in terms of the policy, the goals, targets, and limits, one of the things you have to do is say, okay, here's where we are in terms of our overall credit position. Here's what our risk profile looks like. So what is our appetite for additional risk? Are we willing to take on additional concentrations in certain commodities? Are we willing to make larger loans? Are we willing to just do other kinds of things that could increase our risk? So you have to determine what is your risk appetite, and then you have to identify the risks in the portfolio and set up some key performance metrics. Those are the things that you'll be monitoring. You build that into your strategic plan, establish your portfolio management practices around which the underwriting standards are built. So when we talk about enterprise risk management, these are some of the major risks that you'll encounter, and there are others that are not on here. I was sitting here looking at this and I realized I hadn't even put down regulatory risk or political risk, and that's certainly, those are, for the farm credit system, those are critical. So these are some of the risks. So you've got credit, financial, competitive risk is obvious, the general business environment, the industry, and by industry we're talking about the dairy industry or the poultry industry or whatever the commodity is. Counterparty risk. We'll talk about that a little bit more later on, but one of the things that we do, as I was talking about with Nathan, is we will participate loans back and forth. If we have too much of a concentration in a particular commodity, we will either sell or we will buy risk from a commercial bank. Well, it's important to be sure that you know who you're dealing with and that you've adequately assessed the risk of the counterparty to be sure that they know what they're doing in terms of servicing it. There's technology risk, that's obvious. Operational risk. Is the organization structured to be able to carry on its duties, provide the kinds of service that customers need? Personnel risk, and we'll be doing a whole different session on that on Thursday. Loan portfolio management risk. Have you properly identified the risks in the loan portfolio and set up the controls to make sure you're monitoring it and handling it properly? Customer risk. Well, what about customer risk? Well, you could have fraud, you could have customers who don't have the experience, you may have misanalyzed the customer. Organizational business risk, reputation risk. So these are just some of the risks. It's not all of the risks. And when we did the webinar, one question was asked on the webinar, maybe by someone who was in this group. I'm not sure. If you were, I would like to know that. But one of the questions that was asked was, why haven't we listed environmental risk? And that was one where I went, yeah, why haven't we listed environmental risk? And even in the United States, we have environmental risk. For example, Hurricane Andrew hit the state of Florida many years ago, and it just caused all kinds of devastation with the agriculture in Florida. So environmental risk is something that in certain parts of the United States it's very important to think about. Now, what about climate change? Should that be something that you do strategic planning around? And that's why we don't think of it in the Northeast, because we don't really have, generally we don't have the weather issues or the climate issues that might exist in other areas. But so we added environmental risk, and we can add some other risks like regulatory and political risk. But the main risks that we're going to be focusing on here is credit, financial, and that means making sure you're pricing your loans properly and that you're structured in a way that you're generating adequate profit. And loan portfolio management risk. Are you managing the portfolio the way it needs to be managed? So those are the three main risks that we'll focus on here. Operational risk is also another one, but these are the main risks. And I think earlier, Chandula and Miguel both talked about credit risk and how they handle credit analysis. And I have to say, it was very similar to the way we handle and deal with credit risk in the United States. We talk about the 5 C's of credit, and certainly character is critically important. But so in terms of credit risk, I think there are a lot of similarities. But when you have risk, you have basically 4 ways of dealing with it. You can avoid the risk, you can mitigate it, reduce it somehow, you can transfer it to someone else or share it, or you can just accept it and manage around it. So those are the 4 ways of dealing with risks. And actually in the farm credit system, we use all of those to some extent. And here's an example of, this is on the financial risk side, this is on loan pricing. And typically we price loans very simply. It's based on a risk rating, and it's based on the size of the loan. So in this example here, I'm showing risk ratings that go from a rating of 4 to 5 down to 12 to 14. Now, I'm not showing you 1, 2, 3 risk ratings. Those are for nationally very large types of credits, and we don't see too many of those in our business. So I'm talking like on the retail side of our business, we generally don't even service loans that have risk ratings of a 1, 2, or 3. So we start with a 4 to 5, and it goes down to the 8 rating is what we would consider fully acceptable credit. You get into the 9 and 10 ratings, those are more marginal credits, and then 11, 12 through 14, those are the ones where there's serious weaknesses. And so we increase the pricing based on the risk, and we lower the pricing the larger the loan. And in Ag Choice Farm Credit, we really had 3 categories for price. We have loans less than $50,000, $50,000 to $250,000, and over $250,000. BE simply means the total credit outstanding with a particular customer. And so what we do is we give the loan officers this chart, and it's a guideline. It's not absolute policy, it's a guideline. And we tell the loan officers, use this guideline when you're pricing loans based on the risk and based on the size of the credit. And we also do what we call lifestyle lending. That really is part-time farm loans, and that's a more competitive market. The interest rates on those are generally lower in the marketplace, and so we have a different pricing mechanism for the lifestyle loans. So I'm talking for this chart, mostly agricultural credits. So in terms of underwriting standards, these are some examples of underwriting standards that we use. And so this is owner equity ratio. This is the total equity divided by total assets times 100. In other words, it's capital. Capital divided by assets times 100 based on the borrower's financial statement. And so for each one of these, we have standards. And we'll have a norm, that's what we would expect. And then we'll have a minimum. So we would say generally it can't be less than a certain amount, and if it is, it doesn't mean we won't make it, but if it is lower than that, there has to be a good reason for it, and then it gets reported to our board of directors, and this is required by our regulators. So any exceptions to any of these standards that I'm presenting to you have to be reported to the board of directors. And so you can see some differences there. For example, dairy, the norm and the minimum is 60%. And 50%. That means, what that means to me is that we know those industries, they're major industries for us, we're very comfortable with them, and so we perhaps sometimes take a little too much comfort in the fact that we have expertise in that area. And then there are other ones that it's kind of interesting. We've got independent poultry and swine, it's 60%, but if it's contracted, it's 35%. What that means is independent simply means that they're assuming all of the risk, all of the production risk, all of the marketing risks, Whereas if it's contracted, what it means is someone else owns the animal and takes the production risk, and the farmer is really basically hired to take care of the livestock or the poultry. So there are different standards that we use for the different commodities. Now here's another one, term debt coverage ratio. And basically what this is saying is what's their ability to repay all of their debt based on what their income is likely to be. So we take their income and divide it by term debt to get the term debt coverage ratio. In this case, they're all the same. I plugged them all the same, but you'll see differences between the commodities. So it's a way of making sure that you've got standards in terms of their ability to repay the term debt on the loans. Now, we talked this morning a lot about credit scoring, and I can tell you this is something that's widely used in the United States. We call it Ag Credit Score in Ag Choice Farm Credit, and we have a norm and we have a minimum. And basically what it is, and one thing that Chandler said interested me. He said that credit history is non-mandatory in his shop. And for us, it's just the opposite. We believe, and we can prove it statistically, that a person's past credit history, their performance on loans in the past, is the best predictor of how they will perform in the future. If you can find no other factor that's as predictable as a person's credit history. And so we start with that. So we get a credit score based on past history, and then we will throw in approximately 5 financial factors. For example, net worth, earnings, term debt coverage ratio, things like that, to get at the ag score. Now we score every loan. It doesn't mean we decision the loan. We don't make the decision loan on just based on the ag score, but we do score every loan, and that enables us to, over time, to look at what's happened with these credit scores and what our experience has been to see whether or not we can find reliability, more reliability in just using the credit score. Now, I will say that on loans up to $250,000, and they're generally transaction loans where there's nothing major going on in the business. For example, if there's a major construction going on or a major expansion, we will not approve a loan just based on the credit score. We will do the additional analysis, but we will make a credit decision. We will allow a credit decision based on just the credit score. So it is something that we're using for decisioning, and that's on loans up to $250,000. I want to pause here a second because this is the credit score. When we talk about Farm Credit Services of America and their very robust loan portfolio management system, this is one of the things that even spending $40 million on a system, they're decisioning 40 to 50% of their loans. They don't have any intention of doing 100% of their loans based on credit scoring. So I think their goal would be to get somewhere between 50 to 60% of their loans to be automatically approved or rejected based on the credit score. So you're never going to get away from the need to do individual analysis on the loans. And I would say in Ag Choice Farm Credit, because we have a lot of smaller loans, we're probably at the 40 to 50% approval rate on most of our loans. In other words, we will make a decision based on, we'll make a decision on 40 to 50% of our loans based on just the credit score. And there is risk associated with that, and so you have to think about how you're going to manage your capital. How much additional capital do you need if you think there's additional risk inherent in that? We also look at loan to value. We generally will take collateral. We do make unsecured loans, but it's our policy to take collateral, especially, well, in general, we will take collateral. But there are situations where somebody has high liquidity, good track record of repayment in the past, where we might not require collateral. But it's just a general principle of the cooperative that if you're going to borrow money from the cooperative, it's in the best interest of all of the members of the cooperative to do it in a similar fashion, which means to provide collateral. But we will say that we will not lend more than, for example, in this case, 85%. We won't lend more than 85% of the value on a piece of real estate. And on cattle and equipment, it might be 50% or something like that. So we will set underwriting standards on loan to value, depending on the industry. But this is an example of a long-term real estate loan. And when we're talking long-term real estate loans, generally we're talking terms of 10 to 20 years or 10 to 30 years. Well, let's shift a minute here and let's talk about some goals and targets. So one of the things that we will try and do is we will try and reach out to find new opportunities with young, beginning, small farmers. And so we will say, okay, we want at least 20% of our loans, new loans, to be to young, beginning, small, minority. And we've just started targeting United States military veterans who are getting into farming because they seem to have special needs as well. So this is a category where we've set some goals and we're aggressively trying to achieve those goals to make sure that we're doing new business to these groups of farmers. And when we're talking minority, we're talking female as well. Another goal or target might be that all new loans to a particular industry meet certain underwriting standards with no exceptions, or have the FSA government guarantee or some other sort of credit enhancement associated with them. So we've had situations where an industry, we've been lending to it for a period of time, and for some reason, a good example might be corn or maize prices in the United States, where land values have increased very significantly. And we may say, well, we aren't going to lend above a certain value unless we get some sort of a credit enhancement. We actually have implemented underwriting standards like that. Another one that we do finance the fishing fleet. Miguel was thinking about getting into financing fishing vessels, and we've been doing that for years with mixed experience, I'll have to say. So we've gotten very educated the hard way about how to finance fishing vessels, but it is something that we do. We will finance lobster boats, we'll finance draggers that catch just regular fish, scallopers, shrimp boats. So we'll finance the whole range of fishing vessels. Oysters, now that's actually farming. Oysters is farming, that's not fishing. And sometimes in those industries, what we will find is the government will regulate how much the catch can be because there's depletion of the resource. So they will say the boats can only fish a certain number of days a year, and that imposes greater risk on us. So then we will say, okay, if we're going to do that kind of loan, then we're going to probably lend less and we're going to want additional collateral or additional credit enhancements or something like that. We may require crop insurance on certain loans, and we may say as a target, well, we want 40%, for example, of our borrowing customers to use other financially related services. FRS is financially related services. And what that means is crop insurance, could be consulting. Some associations do tax preparation, record keeping for a fee. So there are other financially related services that we do offer. We do not take checking accounts, so that's one thing that the banks can do that we can't do. And that also imposes a special risk on us because the only way we can generate money is through the loan portfolio. So we have to be especially sharp in managing that loan portfolio because we don't have a wide array of other income sources available to us. Concentration limits. So we will say, okay, no more than 3% of risk funds. That just means capital. Risk funds specifically for us is the allowance for loan losses plus capital, but if you just think in terms of, when you see the word risk funds, just think in terms of capital. So we'll say no more than 3% of our capital to any single borrower. So that would be a concentration limit. Or no more than 60% of risk funds to any single industry, for example, dairy, hogs, or cranberries. Now that doesn't mean that we won't make loans to those industries. What it does mean is if we're going to make loans to those industries, we're going to have to find someone who is going to partner with us to take that risk. So we'll say to the borrower, we will finance you providing we can find someone to partner with to help us manage the risk in the portfolio. No loans to certain industries, and the fishing industry is one where I would say sometimes it just gets to the point where it's so regulated by government that we say we just aren't going to do it anymore because it's too risky. It doesn't happen very often. And by the way, there's one other thing that in the farm credit system, our regulator says if the person meets the eligibility requirements, in other words, they're eligible under the rules and regulations as set forth by our regulator, the Farm Credit Administration. So if they're eligible and if they're creditworthy, then we have to do the deal, or we have to have a real good reason for not doing the deal. So we don't have the alternative of just deciding that we're going to be in an industry one day and out of the industry the next day without some real good documentation, some real good reasons why we're doing that. Another possibility is to say, well, we're going to limit our participation loan business to 20% of our total loan volume, for example. So what that means is we're not going to buy any more participations than 20% of our total outstandings. So what that does is it preserves our capital, which is very precious. It preserves our capital, and it assures that we have adequate capital to provide credit to the customers in our local service area. So that's one reason why we would do that. Tenors and loan terms is another way of managing the portfolio. I talked earlier about loan terms, and for us, we think in terms of short and intermediate term loans, and the short term and intermediate term loans would be 1 to 10 years, and we will go up to 15 years on the fishing vessels, but generally we also take real estate collateral in addition to the fishing vessel as collateral. And the long-term loans I already mentioned, that's generally 10 to 30 years. We really don't go longer than 20 years. We try and keep the term 20 years or less. Underwriting standards that relate to tenor, we will say no fixed rate loan longer than 5 years. So we'll use a 20-year amortization with a balloon in 5 years. And what that enables us to do is reprice the loan whenever it's necessary. And then we will want to match the loan to the effective life of the asset. So in terms of loan portfolio analysis, there are several ways, several methods that we look at that. We use something called strategic credit risk management, and I'm not going to go into the detail on that. You can read it here, but it involves several steps in the process. And I put in here some stress testing examples. So we'll create some scenarios and we'll say, well, what happens to the portfolio if dairy prices drop, or if the cost of feed increases, or if the unemployment goes to a certain level, or if in the forest products industry we do make loans on forests. What happens if housing starts weaken, so on and so forth. So I put in here some stress testing examples. You can look at that, and behind that you'll see the actual table of the output that gives you the results of the stress testing. And you also can do certain other scenarios. What happens if income increases 4% or expenses increase by 3%? So this is just some examples of how we would use that. This is impossible to read, and I only put that in there as a placeholder so I'd remember to talk about it. But we also look at what happens if interest rates change dramatically. So we'll stress test changes in interest rates. So that's what this is. We'll say, well, what happens if interest rates go up by 3%, and what happens over time? So that's an example of how we do that. I talked about the monitoring and reporting. We've got a robust internal audit and credit review system, asset liability committee that looks at the relationship between our assets and our liabilities. We do regular board reporting of exceptions. I already mentioned that. We have our bank that funds us, does an audit. We have an accountant review. We have regulator reviews. So there's all kinds of monitoring and reporting that goes on. We do diversification in terms of lines of business and commodity through participation loans. We get credit enhancements and government guarantees. We will adjust our hold positions, and we'll also adjust our growth targets. There may be times when we see opportunities to do more growth, or we say, well, we've been growing too fast and we need to reduce it a little bit, so we'll adjust that as well. Portfolio monitoring and risk management, we monitor trends and we see what's happening with migration in the portfolio. We look at our risk-bearing capacity, delinquency monitoring. We look at the industries, what's happening with the risk, the large loan concentrations, counterparty risk, contingency plans. Now, capital management, we have our allowance for loan losses, and we have economic capital, which is simply the capital that's required for us to operate safely and soundly. And as a cooperative, we do pay patronage. So one of the things that we can do is limit the amount of patronage that we will pay to a customer. Now, typically, we will pay about 20% of the interest paid. We will pay that back as a refund. So we can limit that as well. This is the black box of enterprise risk capital analysis, and we use a SunGuard product, or we have used a SunGuard product. We're going to be moving to a different one. The data goes in to the black box, then something happens, and we're not privy to what happens, and it happens within the box, plus it pulls information from outside the box. We don't know what happens, and it tells us how much economic capital we're supposed to have, and this is the result of that. And if you look down at the bottom here, what it says is we have a capital margin of $67 million, which means we've got more capital than we should have. Now, if I knew what was going inside the box, I'd take comfort with that. But since I don't know what's happening, I always like to have a solid plus margin there. And this is just another way of keeping track of what's happening in terms of credit risk migration. We monitor the payoffs because we want to know what's happening with our competition. I'll skip that one. We look at the margins in each of our products, and we also look at what the rate is that the customer is paying, and we want to see what's happening in terms of those trends. This is a dashboard. This is what we would put into SharePoint. So if you don't remember anything else, the SharePoint dashboard is really critical, and it has a lot more stuff than this. And we color code it so that it jumps out at you. If you see red in there, you know it's something you need to pay some attention to. And the staff, it's easy for the staff to use as well. So everybody has access to our dashboards. Then the action or the contingency plans, we have a whole list of them in here. You can read those. And we're right back to where we started, which was the conclusion that I started with. So annual enterprise risk management survey, strategic planning, the goals and targets, monitoring, reporting through SharePoint, stress testing, contingency plans, a robust internal audit and review, and I think that concludes it. I'm happy to, later on, if anybody wants to email me with any questions or follow-up, I'm happy to answer that. So I'm representing Farm Credit East and Ag Choice Farm Credit here today, so I put both of their addresses up there. So, thanks, Tom.